Welcome to the Deep Dive. We're here to cut through the noise and bring you some essential insights. Today, we're really diving into something pretty fascinating, right at the crossroads of finance and tech. We're zeroing in on a very bold prediction from Ark Invest, you've probably heard of them, about Tesla's future stock price. So the big question we're tackling is, how do firms like Ark even come up with these really ambitious price targets? And, what do they actually mean for us? Our mission, if you like, for this deep dive is to sort of unpack their methods, take a hard look at the assumptions they're making, and really understand the huge bet that's sitting right at the heart of this forecast.
That's exactly it. Yeah, we've been looking closely at this analysis from Ark Invest, the one projecting Tesla could hit, get this, $2,600 a share by 2029. But as you'll see pretty quickly, it's not just about hitting that specific number. It's more about understanding, what's driving that kind of valuation. And really crucially, the immense risks that are involved when you're basically betting so big on the future.
Okay, let's jump right in then. Ark Invest's big headline number, $2,600 for Tesla, ticker TSLA, by 2029. I mean, that's a massive jump from where it's trading now. So how on earth do they generate a number like that? What's the actual method?
Yeah, it's interesting because it isn't just a straight forecast. They call it an expected case scenario, and it comes from something called a Monte Carlo simulation. Think of it like this. They take dozens of variables, stuff like, future revenue, profit margins, how quickly things get adopted, and feed them into an algorithm. Then they run just vast numbers of computer simulations, thousands, millions maybe. Each run uses slightly randomized outcomes for those variables, and this helps them model a whole range of possibilities. For this Tesla target specifically, their simulations suggest there's about a 25% chance the stock ends up at $2,000 or less by 2029, and also a 25% chance it could go above $3,100. So that $2,600 target, it sits right there in the middle of the sort of expected value from all those simulations.
Okay, that explains the complexity. A lot going on there. But here's what really jumped out at me. The source we looked at explicitly says, and I'm quoting here, the modeling itself is almost certainly wrong because it relies on these variables that are just incredibly hard to predict accurately. So if the model itself is almost certainly wrong, I mean, what does that really mean for you listening, whether you're an investor or just, curious about this stuff?
Right. It means, look, you've got to take these numbers with a pretty big grain of salt. A healthy dose of skepticism is definitely needed. And maybe zooming out for a second helps understand why they'd say their own model is almost certainly wrong. Let's just look at their track record with Tesla forecasts. Okay, rewind to 2021. Ark put out a forecast for Tesla in 2025. Their bear case was $1,500, the bull case $4,000, and the expected value, like this one, was $3,000.
Okay.
Then, jump to their 2022 forecast, this time looking ahead to 2026. The bear case jumped to $2,900, the bull case to $5,800, and the expected value hit $4,600.
Wow.
Now, think about Tesla's stock price today. It's hovering around, $320, give or take.
Yeah, about that.
The contrast is, it's stark, isn't it? Today's price is way, way below even the bearish scenario Ark simulated back in 2021. Actually, for Tesla to hit just the bear case for 2026, the one projected in 2022, the stock would need to climb by, wait for it, 806% from where it is now.
800%. Just to hit the low end of their prediction from a couple years ago.
Exactly. And look, this isn't really about criticizing Ark. Modeling these kinds of long-term speculative growth stocks is incredibly difficult. Everyone knows that. But it absolutely underscores the point. Oh. You can't treat these targets like, gospel truth. As the saying goes, predictions are hard, especially about the future.
Right. Okay. So if these price targets aren't gospel, what can we take away from Ark's analysis? For us, the curious learners or maybe potential investors, what insights do make sense here? What's the real value?
Well, this is where it gets really fascinating, I think. The key takeaway isn't actually the $2,600 number itself. It's what the model reveals about Tesla's underlying business strategy, or at least how Ark sees it. The analysis basically shows that Tesla's share price is incredibly sensitive, profoundly sensitive to how quickly they can scale up their Robotaxi service and their full self-driving FSD capabilities.
Ah, okay.
So it immediately raises this crucial question. Just how big is this bet on Robotaxis in their valuation?
And when you actually dig into Ark's numbers, I mean, this Robotaxi bet is absolutely central. It's almost everything. For that $2,600 target in 2029, their model assumes a staggering 88% of Tesla's entire enterprise value.
Yeah, the whole company value, debt, and equity.
Right, 88% of that comes purely from the Robotaxi business. And what about their main business now, selling electric cars?
Get this, only 9%. Just 9% of the value is assumed to come from traditional EV sales by them.
That's a fundamental shift. It's basically saying Tesla won't be primarily a car company anymore.
Precisely. It's not just a shift in where the money comes from. It implies this complete redefinition of what Tesla is, moving from, mainly making and selling cars to being a transportation service provider. It's a total paradigm shift baked right into their valuation model, and it really shows how Ark sees the future of mobility playing out. So the message from their model couldn't be clearer. Really. If you're thinking about investing in Tesla based on this kind of valuation, you have to fundamentally believe there's a really good chance its robotaxi service is going to work, and work big.
Okay, but let's pause on that for a second. The reality of this robotaxi dream, it's fraught with risk, isn't it?
Absolutely.
I mean, Tesla's unsupervised full self-driving system, it's still largely unproven for widespread driverless use. The whole robotaxi concept itself hasn't really been proven at a massive commercial scale anywhere yet.
True.
And we know they haven't even started volume production of the dedicated vehicle, the Cybercab. Plus, you've got all the regulatory hurdles, huge safety concerns. It's a minefield.
Yeah, the regulatory side is massive.
So, putting it bluntly, this robotaxi business feels like a really high-stakes gamble. And if it doesn't pay off, well, failure seems like it would set Tesla back significantly.
No doubt, it's definitely a speculative growth area. But, you also have to look at Tesla's position. They do have some clear advantages. They still dominate the EV market, for one. And interestingly, some big rivals like Ford and GM, they've actually pulled back from the robotaxi race, at least for now.
That's a good point.
And look, the entire auto industry has poured billions into trying to crack autonomous driving. Tesla certainly isn't alone in, let's say, over-promising and under-delivering on timelines over the years.
Right, that's fair.
But the difference is Tesla is actually launching its robotaxi service. They plan to anyway. They already have millions of vehicles out there gathering data, this massive data hoard, as people call it, from their FSD beta users. They have significant cash reserves, too, which helps fund this kind of ambitious project. Plus, they are arguably really well placed to start making lower-cost EVs, which could be perfect robotaxis. And the company itself says it's on track to start volume production of that Cybercab in 2026. So the pieces are potentially there.
Okay, so bringing it back to you, the listener, trying to make sense of all this, where does Ark Invest's reasoning ultimately land us? And what does this specific case tell us about the bigger picture, the future of transport, the future of investment?
Well, Ark Invest might be right about one really fundamental thing. Whether that $2,600 number is right or wrong, the robotaxi business probably will be absolutely key to Tesla's value long term. And maybe, just maybe, it's key to the future of the whole auto industry. Now, it's still a huge if, of course. If Tesla can actually nail the technology, make it safe, reliable, get regulatory approval, then there could be significant upside for the stock, simply because, as we've sort of laid out, many of the other operational ingredients seem to be in place. The cars, the data, the manufacturing muscle. They have the potential platform to make it work.
So this whole deep dive, it really shows how even a financial projection that seems, frankly, audacious, and one that the creators admit is likely wrong in its specifics, can still shine a powerful light on a company's core strategy. Even if the numbers are speculative, the analysis behind them, the why, can give us some really profound insights into where markets might be heading.
Absolutely. It forces you to think about the underlying assumptions. So maybe a final thought for you to chew on as you think about all this. If the future value in the auto world really does shift away from selling individual cars towards providing autonomous ride-hailing services, what other industries might be facing similar kinds of transformational bets right now? And maybe more importantly, how does that change the way we should evaluate companies, technology, and, the future itself?